Hello traders and investors, welcome to the trading direction. On this very important occasion that we have crossed 1000 family and we are declaring now we are going to some valuable informations which is we are giving free of cost for our trading direction subscriber. Yes, we are launching project options. In project options, we will give step-by-step thorough knowledge about the options trading, which options are good and what is call option, what is put option. From basic to we will slowly proceed to the advanced. Now this is the first episode. We will see what is call option. There are two types of option, call option and put option. Call option means when you are bidding and you are expected that the prices will go up, that time you can buy call option. Understand the basic characteristics of the options. Comparatively, stocks stock don't have expiration. Stock can be purchased now and sold at any time. There is no force unless and until that company is open. You can hold that stocks, and for 10 years also you will be the owner of the stock. Whereas in options there is particular expiry. Yes, there is particular validity, maybe 3 months validity, 4 months validity, 1 week validity. There are some kind of validity, and based on that validity also premium rates are decided. Premium rates means the valuation of the that options that we called as a premium. And the stock has the ownership, but whereas this by buying one options you will become owner, but legally you will not become owner. There is one financial contract between you and the seller. Strike price is the price at which shares can be converted. So that price, that valuation is known as strike price. If you are expecting the stock price will rise, then you can buy call option. That call options price will also increase with the increase of stock price. And if you are expecting that the stock price will fall rapidly, then you can buy the put options. I will give a wonderful example of a property, real estate property. Let us say there is one bungalow in Pune area, and that Pune you want to buy that bungalow, and that price is 40 lakh rupees. So the market price is 40 lakh rupees, and you are expecting that in a certain period of time, after certain period of time the price will increase. So but you don't have the valuation, whatever valuation is there, that much amount you don't have. Let us say that valuation is 40 lakh rupees and you don't have 40 lakh rupees, but you want to take right of that selling that house if that prices will increase rapidly. At that time you may have the options. Okay, so that whole the stocks can be divided into small stocks, and that you can buy a premium. You can pay a premium. Let us say you are paying a premium of 10,000 rupees. In that 10,000 rupees you are doing on financial contracts. If the prices will rise, then that you can buy it. So you paid 10,000 rupees, and in 1 month or let us say there is one crisis about the boom in the real estate market, and there is increase in sudden price change. In 1 month it become 41 lakh. Okay, and when it becomes 41 lakh, so the whatever additional rate is there, 1 lakh is your profit. So you can buy that house, and already you remember you already paid 10,000 rupees, so your net profit will be 90,000 rupees. You can execute that contract and you can take 90,000 rupees a profit. Yes, this is a better golden situations, but this golden situations most of the time it may happens or may not happens. There is one rule in the contract or these options. if the prices suddenly price change happens, there is one momentum created, then option this you are buying, option buyers get profit. Suppose another scenario, if prices will not rise, let us say instead of rising from 40 lakhs to 41 lakhs, it reduced to 39 lakhs, or it remains 40 lakhs. At that time, the time is gone, so your premium decay happens. That factor is theta factor. What are these factors? We will see later on. First episode only you remember, if the prices will not increase, then your premium rate will go down, your loss is 10,000 rupees, maximum loss is 10,000 rupees. Prices are not going up as you are expected, then you can come out of that position, you can sell that position immediately, square up that position once it comes to 9,000 rupees, or you can wait up to 8,000 rupees. So you can come out of that situation. That also you can do, so that you can minimize your risk. So remember, when you are buying call options, your view is that there is a rapid movement in the market and the prices will increase for a particular period of time, then you can buy call option. What is the interest of call option buyer? When the stocks or index is incredibly volatile, then that volatility will increase the premium rates. The faster the volatility, the faster appreciation of the premium rates. Then suppose you bought that premium rate of 10,000 rupees, and it within 1 hour also it increases to 20,000 rupees. So 20,000. So that additional 10,000 rupees is your profit. Immediately you can square off, and that additional profit you will get it. So the incredibly volatile stocks you need to select, like Infosys, like Reliance, Axis Bank, which are the highly volatile stocks. There you can buy the call options. And in index like Bank Nifty is incredibly volatile. Within 1 day it moves 600 to 700 point on an average. So at least it moves 500 points. If you are able to enter, and after that 200 points also it moves, then also your value will get increased. If it increase very smart, how much premium will increase, it is depending upon the speed at which the prices are increasing. In some trending market also, if prices are increasing slowly, then that will not work. If the range bound market also, if sudden volatile move comes, that time also premium prices increases. So this is for first episode. Next episode we will learn detail about which strike price you need to select, and what is put option, where put option works, and what is location effect, and what is the at the money, in the money, or all out of the money. Detail we will learn in the next episode. We have launched a Saturday program which is 99 rupees of cost, which is how to master trading psychology. You can master trading psychology by only 99 rupees. It's worth only for valuation we have kept. So value is very good. 1 hour live coaching, interact with me and learn what is the psychology, and then you can master psychology, which is 60 to 70% of your trading success. So improve your psychology to improve your trading profits. Come on, join. The WhatsApp number is below, and the link is also below. Just register and send WhatsApp message. You will get the link for your next webinar. So you can join it, and congratulations. Thank you very much. Share, subscribe to the Trading Direction. See you in the next video.